We usually focus on the asset, picking the right company, physical property, or stock. But judging an investment solely by its expected return is an obsolete strategy. Today, your money splinters into a massive, complex system of structural wrappers. Over the last few decades, traditional public markets grew by about 3.7 times. Meanwhile, private markets expanded to 18 times their initial value. We constantly balance the modern investor's trade-off, weighing accessibility against how fast you can get cash out and how much data you have. A quadrant chart maps this trade-off. Traditional stocks and bonds sit in the top right, highly liquid and transparent. But with the rise of fractional crowdfunding and decentralized exchanges, fine art, real estate, and OTC Forex populate these opaque, lower liquidity zones. You can pick a winning asset, but if you buy it inside the wrong wrapper, you could face brutal tax inefficiencies, capital locked up for years, or massive pricing gaps. We are going to audit how we buy assets today. We will evaluate liquidity, the varying levels of transparency, and how trading hours dictate flexibility. In a hybrid market, the only way to protect your wealth is by matching the mechanical realities of these wrappers directly to your exact lifestyle constraints. For most investors, the foundation of a portfolio relies on pooled vehicles, mutual funds, and ETFs. They offer professional management and broad diversification without the need to pick individual stocks. However, mutual funds have a strict mechanical limit. They calculate net asset value only once a day, after the markets close at 4 p.m. Any order you place during business hours executes at that single end-of-day price. This comparison table shows where active mutual funds fall short on modern demands. Beyond the daily pricing lag, they are only required to disclose their holdings quarterly, often with up to a 60-day delay. Cash redemptions can also trigger capital gains distributions that pass directly to you, creating unexpected tax bills. Exchange-traded funds solve the pricing lag by trading continuously on an exchange. And by looking at the expanded tax management row, you can see how ETFs use an in-kind creation and redemption mechanism. They swap baskets of underlying securities instead of selling them for cash, which neatly bypasses those capital gains taxes. That efficiency comes with a trade-off. Daily full holdings disclosure and intraday trading mean you must navigate bid-ask spreads, and your portfolio is fully exposed to minute-by-minute market volatility throughout the entire trading day. Prioritizing an ETF over a mutual fund means giving up the calm simplicity of end-of-day pricing to secure extreme tax efficiency and complete control over your liquidity. Stepping outside the stock market, tangible alternative assets like real estate and art act as a hedge against inflation and historically have a very low correlation to equities. But they suffer from severe search liquidity. Selling a physical property takes months. Even accessible wrappers, like real estate crowdfunding platforms, enforce lockup periods of 3 to 10 years. Your capital is trapped exactly when you might need cash the most. Contemporary art operates as another high-yield wrapper, with top-tier indices historically returning around 13.8. This leaves retail investors relying completely on subjective appraisal standards to guess what their holdings are actually worth. Because valuations are subjective, a single gap in a piece's documented ownership history, its provenance, or a newly discovered physical flaw can instantly wipe out up to 90% of its value. This bar chart outlines the harsh reality of transaction friction. While public stock trades cost near zero, liquidating real estate routinely eats up 10% of the asset's value in commissions and taxes. For art, auction and dealer fees can consume anywhere from 20 to 40%. Chasing the excess returns of private tangible assets forces you to surrender transparent pricing and accept severe illiquidity. You are playing in a market where the institutional insiders hold all the data. For active capital allocators, 2026 regulatory overhauls altered the barriers to entry for trading and access to leverage. Historically, the pattern day trader rule required anyone executing 4 or more trades in a 5-day period to maintain at least $25,000 in their margin account. It excluded smaller retail participants from high-frequency trading. By mid-2026, the SEC approved new rules eliminating that $25,000 minimum requirement. Under the new intraday margin level framework, traders can enter and exit equity positions freely with as little as $2,000 in buying power. While stock trading is vastly more accessible, standard U.S. exchange hours still lock you into a rigid schedule. If geopolitical news breaks overnight, you are completely exposed to gap risk, waking up to find the market opening significantly lower than it closed. This makes futures and options on futures a highly capital-efficient alternative. They offer nearly 24-hour access 5 days a week. Using the span margin system, which evaluates your entire portfolio's risk, they require far less capital upfront than standard equity options. Futures are traded on centralized, highly transparent exchanges. Contrast that with the global forex market, which operates entirely over the counter through a decentralized network of banks and brokers, leading to variable pricing and shifting spreads. This scorecard breaks down the 2026 regulatory landscape for active traders. Regulators capped retail forex leverage at 50-1 in the U.S. to protect investors. Meanwhile, futures retain their massive Section 1256 tax advantage, where 60% of your gains are taxed at the long-term capital gains rate, regardless of how short your holding period is. But look at the highlighted risk columns for Forex and futures. The true danger of these derivative wrappers is the unlimited downside. If the market turns against you, losses can far exceed your initial margin deposit, requiring daily cash settlements just to keep your positions open. Democratized access provides you with unparalleled leverage and capital efficiency, but it shifts the burden of daily mark-to-market pressure and extreme regulatory risk squarely onto your shoulders. The fine print is now the most important factor in capital allocation. Understanding the structure of your investment dictates whether you succeed or fail. This decision tree maps out a practical way to filter these wrappers based on personal lifestyle constraints. We start with a core question. Do you need intraday liquidity? Following the path for the time-poor optimizer, if you need passive structures, high systemic liquidity, and tax efficiency, your capital belongs in exchange-traded funds, public REITs, and money market funds. If your schedule allows for active management, we follow the path for the active allocator. To get high reactivity to global news and maximum capital efficiency, you require the 24/5 access of futures or the newly accessible post-PDT equity markets. Taking the illiquid route brings us to the alternative yield seeker. If wealth preservation is paramount and you do not need immediate cash, you can lock your capital away in fractional art or real estate crowdfunding, provided you are willing to rely on private sponsor appraisals. Every investor must explicitly define their constraints, time availability, tax needs, and emergency cash requirements before purchasing a financial wrapper. In an era where public transparency and private opacity collide, capital alone is no longer enough. The most valuable asset you own is the structural knowledge required to deploy it safely.